Okay, welcome back. The market's up 155 points and it's looking pretty good, all told, and very unlike the early 1.5 hours of volatility. Will we see more of it? Last 3 days, remember, the market's come off. By the time we've shut shop, we've been sharply off the day's high. Yesterday, it was 200. It was almost 300 the day before. And of course, last Thursday, it was about 170 odd points or so. So, after all of that, this is a decent pullback if we manage to end with these gains. Anish Tawakley is now joining us. He's Deputy Chief Investment Officer Equity at ICICI Prudential Mutual Fund. Anish, good afternoon. Great to have you with us here on CNBC-TV18. It's a pleasure.
Good afternoon, Prashant. Good to be here.
Good to have you, and I hope this is the first of many. You folks at ICICI have always known to be contrarian. But now the problem in the market is that you have to find stuff to be contrarian on, right? Over the years, you bought power stocks when they were down and out. You bought, other things which were very cheap. PSUs, for example, early on. But compared to historical valuations, very few sectors actually give you that comfort now. So what's the thought process? What's the approach from the investment team at ICICI Pru?
So, Prashant, basically, look, you get returns through two sources, right? One is multiple expansion. The second is earnings. I would agree with you that multiples have expanded pretty much across the board, and there are no sectors that are screaming cheap at this point. I don't think we can identify any. But fortunately, the economic outlook, at least from a cyclical perspective, is positive. And the earnings growth trajectory we do expect over the next few years should be healthy. And when you have an economy that's poised for a cyclical recovery, it's the domestic cyclical sector that we kind of expect to do well. So this would be sectors like automobiles, cement, industrial and capital goods, normally financials. This time I would say financials other than banks, so insurance companies, asset managers. Broadly, the domestic cyclical space is where we are positioning ourselves.
Anish, you've led me to the next question. Hi, this is Reema here. Why not banks? Last year, everyone we spoke to said banks are a screaming buy, the asset quality is under control, loan growth is picking up. Yes, NIMs will moderate, but it won't be such a big hiccup. Why have you been cautious on banks, and what's the view from here on?
So our view was that everything that could have gone right for the banking sector had gone right, and the competitive intensity was increasing following the consolidation that had happened in the banking industry or in the financial industry more broadly. So the fight for deposits we expected was going to be very, very intense, and that is playing out as we had expected.
Anish, just stay on. You also did mention that you like other stuff in finance. To come back to your point, you mentioned that, you're sort of looking away from banks, and I guess you're a bit ahead of the curve because the market's only waking up to that reality now. Tell us, what do you feel about, the non-bank lenders and also areas like insurance, where there's a lot of regulatory action, whether it's higher surrender values or these tax tweaks that we keep seeing. So, the regulatory piece, would that not be an overhang?
Yeah, so the way we see the financial sector broadly is there are three sources of intermediaries between savers and investors. You have banks and NBFCs, that's one. Second are asset managers, and the third are insurance companies. Now, in a cyclical recovery, normally both savings and investments pick up, and you should see strength across the board. This time, our view was that in the banking and NBFC space, there would be heightened competition, so we were a bit cautious there. But the other two would still be beneficiaries of a cyclical recovery. So asset managers and insurance companies, we've been positive on. Of course, there are regulatory issues that can keep cropping up. And that you kind of handle by how big an overweight or underweight, how big you take a weight you take based on your risk appetite. But the underlying cyclical trend was positive.
By the way, important statements from Bharti Airtel about capex will moderate from FY24. This was the big thesis in the market that Bharti Airtel and Reliance Jio have both front-loaded their 5G-related capex. But now that they've met their rollout plans, both these companies, they've achieved whatever they wanted to in terms of rollout. going ahead, FY25, the capex intensity will come down, which means there's more money in the hands of Bharti Airtel, and maybe we could see that being given out to shareholders via dividend. So, you know, the company coming out and saying that we will see a moderation in capex in FY25. I'm just trying to see if they do hint anything about a possible tariff hike post-election. I'm sure the investors will be asking them.
No, absolutely. And stocks up about, 2.25%, 2.33% right now. Anish, let's just, PSUs are not a one homogeneous group, right? I mean, it's just defined by ownership, but it's so vast and varied. But you guys were sort of positive early on, and now you find valuations and levels less favorable there. But we're still seeing, mutual funds launching PSU funds. So fresh money coming into that space, will come into that space if this continues. What are the areas which you still are bullish on, where one can still allocate within the space? As defined by ownership, as I said, it's not homogeneous. But if I were to use that PSU as a basket, where is their value, or what will do well, according to you?
So, as I said, there's no area which is extremely cheap at this point, and neither are PSUs that cheap anymore. See, the reality is that the outlook and performance of the PSUs have improved, and some of the re-rating is justified. But at this point, at least our view would, they are closer to being valued fairly, and one should gradually be taking money off the table.
Take money off the table. Just a quick word on autos, which you do like. What's the thesis here, and what specifically? Are we talking about two-wheelers, tractors, commercial vehicles, four-wheelers? What segment there, and why?
So we are more positive on two-wheelers and passenger vehicles. I think in a cyclical recovery, these are discretionary items of spending, right? When the economy is soft, these are the items that drop disproportionately. And correspondingly, when the economy picks up, that's where the incremental output comes from. So both two-wheelers and four-wheelers, and particularly at the bottom end, right, we feel that as the economy broadens out, you would see a stronger recovery in these segments.
Anish, I just want to sort of chip in over there with another question. Since you're talking about the whole, industrial thesis, and you're still positive on that space, the thing is that, earlier on, a couple of years ago, you guys were the outliers, the anti-consensus call of looking at a lot of these capex stocks. But now that has become the market call, and all these stocks are, they're running through the sky. So what is the approach you're taking on industrials, the whole capex theme? How do you find valuations now, given previous cycles and comparisons? And how are you going about deploying money here?
So the approach we take is that, look, are earnings upgrades more likely or downgrades? Right now, it's not a game of multiples. Multiple expansion has taken place, and we are not betting for further multiple expansion. It may happen, but that would be upside and the cherry on the cake. But we are looking at earnings outlook, and the view is that if the economy gains further momentum, which we do expect it to, you are more likely to see upgrades in these sectors than downgrades. And we will change that, when we feel, look, the upgrades are done, the models are being stretched to a point where, upgrades are very unlikely and more likely that companies will start disappointing. That's when we'll switch.
Okay, so within that, I mean, are you more comfortable right now, let's say, with a lot of the heavy engineering companies on the capital goods side, or are you looking at, contracting firms? What? Because
Both,
it's a large
actually.
complex, right?
Look, when you run a large portfolio like ours, right, basically you do have to look broadly for opportunities, and we find industrial and capital goods, automobiles, cement, across the board, right? You can if they do well, they'll all do well together, right? The earnings upgrade should come through in all of these sectors. If the economy doesn't deliver, then you'll have problems across these sectors. It's not like one sector you can pick and say the other one will not do well.
Did you guys see that story, by the way? Hyundai apparently is coming out with an
looking
IPO.
to list in India. And I think $2.5 billion, I think that's going to be the size of the IPO. Some of those reports are to be believed.
So I went and looked at what Hyundai's market cap in Korea, which is the home country, is. It's about $37 billion. You know what multiple it trades at? 5 times.
5, yeah.
5 or 6 times earnings. PE.
Price to earnings.
It'll
start at some 40 times.
40, 50. So the point is, by the way, dividend yield there is 14%.
Wow.
It trades at 5 times. So the question is, why not?
Why
the
not?
market is giving you the multiple, gather it. So I think, it just sort of struck me as he said that Anish was saying that he likes the auto space. Anish, just a quick word on cement as well. That's the other space that you like. What's the thesis there?
Look, I think home building and urbanization will be a key part of the growth story going forward, right? And if you see home building, etc., taking place, then cement is certainly going to, volumes-wise, do well. And this is a material that can't be imported, exported, right? It's a very local market. So if you have strong positions in the local markets that you operate in, you do well, basically. And our view is that urbanization and home building will be a key driver of growth. In fact, if you look at how the economy has shaped up and what's driven the recovery, it's basically coincided with a pickup in home buying. The inventory is cleared and then home building activity has started. So home building is central to this thesis of the economic recovery, and cement is a clear beneficiary of that.
Anish, I remember that a couple of years back, you used to look at IT very closely. We haven't spoken about your view on technology in the current cycle. Now, the stocks have already done well, considering the financials they've reported over the last 9 months. What's the call on IT?
So our published portfolios were slightly underweight IT. We don't think that growth will be spectacular. I mean, this should be a normal kind of year for IT, for the IT industry. See, in a normal year, IT services industry grows 3 to 5%. Indian companies grow faster because they gain a little bit of market share. This should be a normal sort of year, right? Then additional benefits the IT industry gets if the rupee depreciates, which is not our view this year, right? We don't expect big rupee depreciation this year. So IT, we are slightly underweight.
Anish, before we let you go, any sector or any particular area of the market where you see froth, where you really think that there are excesses and something you may want to red flag for our viewers?
I think small and mid caps are an area where we are seeing a lot of froth. That's being driven by flows. And I think people are extrapolating peak profitability and very strong growth for very long periods of time. So in the small and mid cap space, we'd be careful.
Anish, great conversation, and we look forward to more conversations with you. Thank you for joining in.
Thank you very much.
We'll slip into a break on that note. On the other side, we'll get you a check on what dealing rooms are saying in our segment D Street Chatter. We also get you a few BTSD calls from our technical expert.